Welcome to readtheticker.com. Wyckoff logic not working for you? This may be why, and it's the most common reason, I would think. Incorrect position sizing at high risk entry zones. Ideally, you want the correct position sizing at the low risk entry zone. A low risk entry zone has the most Wyckoff evidence to support the entry. Believe it or not, the original works of Richard Wyckoff, by its nature, is a very conservative approach. The original Richard Wyckoff rules for entering a market were made up of 9 rules, and this basically says we need evidence that the distribution or the selling is stopped. We need evidence of accumulation. We also need evidence that it's the right accumulation. We need strong evidence that supply lines are broken. We'd like to see a higher top, price breaking into new ground above the supply line. And we also want to see point and figure chart analysis that the accumulation pattern has been long enough or wide enough to support a decent markup process that follows. That's the high level summary of these rules. You can read those in your own time. But here's a graphic view of it. This is the Richard Wyckoff accumulation pattern. It could be a triple bottom, a double bottom, a saucer, inverse head and shoulders, what have you. They all have their own characteristics. But let's break it up into at least 5 phases. The first phase is the downtrend, supply lines. Phase B is the breaking of the downtrend with supply and trend lines that are broken, busting new highs, and the selling and the downtrend is tested during phase B. This is also the major accumulation period for the big boys. Retail accounts should not be in here because they're doing all the tricks of the trade to release stock float and accumulate. And phase C, D and E is when the trend starts to move up. You'll have your last moment of shakeout where they take prices down to bust out anybody who might have accumulated and who don't have the ability to hold through a 3 to 5, 10% punch down on price. So accumulation happens here, and all those weak hands get busted out here so they can get some more. And then they start to show their hand in phase D, where they rally price up and it starts to break support lines and starts jumping across the creek. And then the markup begins. Now the most important and success zone for a Wyckoff trader is in phase D. That is where the hand of Mr. Market has been shown, or the composite man. We have a sign of strength, we have a breakout into new ground, and we have a test of that, and that is where Wyckoff traders should be considering their entry. Other entry zones, which obviously people consider down here, it might be the spring or a little test, and even secondary tests or what have you. They are higher risk entry zones. Let me explain that more. Here we have a simple guide of where the risks are and where the risks are not. We have our accumulation pattern, strength, test, reaccumulation pattern, distribution pattern, redistribution pattern, and a reaccumulation pattern here. Trades entry are E1, E2, E3, E5, E6, E4, missed one. And obviously the red ones go down E1, E2, E3, E4, E5, E6, and what have you. E1 and E2 are considered high risk zones. Because quite frankly, there's no reason why E1 and E2 could be over here and the pattern hasn't really shown its strength. So E1 and E2, if you're a Wyckoff trader and you're putting a lot of position sizing into these type of trades, and you are not doing well, that is because these are higher risks, because there hasn't been any evidence that it's broken to new ground. E3 is you've got the base, the break into new ground, and then the subsequent subsequent test of the pattern, and then continue on. The same up here, you've got E5 and E4. Quite frankly, E5 and E4 could be in the pattern, and the pattern accumulates some more. You really want to see price break out into new ground and test that and continue on. Obviously, you don't always get a chance at E3. You may miss out. You may watch a pattern for months, breaks out, and you don't really get much of a test, and you really can't get in. Well, no. When you go to the dance, you don't always get a chance to meet the girl. So not everything works out. But just be aware, E1 and E2 may be further deep in the pattern, and there's no evidence to suggest that it's going to be markup pattern until it's broken into new ground, and then the odds increase. So the high odds for a Wyckoff trader are E2, E6 on the upside, and E3 and E6 on the downside. For the simple reason, there is more Wyckoff logic evidence to suggest that there's something that's going on, and there's a markup process or a markdown process. It means there's a large incubation period, there's a large build-up. I'm just trying to make the point, if you're going to start putting in large position size, so taking 10% of your portfolio, wait till you get an E3 or an E6. If you want to get in a bit earlier, a low position size, E1, E2, just be aware of that E1 and E2, it may not be the end of the pattern that is forming. Let's have a look at some examples. We'll go to the Japanese yen inverted. This is the FXY inverted, a very famous rally. Okay, here we go. Supply lines. Some volume, you can see the volume here. We've got a sign of strength here, and a bit of a basing here, but it's not much of a base, it's not very long. We really had a pattern that built up over a period of time. Price ran up to upper resistance. See this, here's your resistance, 1, 2, 3, very strong. It came back and retested the consolidation. This is all about when Japan went super crazy on the Abenomics and really moved the currency to change their economy. So it's widely forecasted. This is the initial speech, but it didn't actually start until 9 months later or something. It was about 6 to 9 months later when they started buying into it. And this was the easy money rally. And as you can understand, easy money is not given to the trader that easy. So we had a sign of strength here. We had a rather large pullback. Then we started to move up again. This was the real McCoy. And that's where your little patterns are in there where you can break out. This is widely forecasted by the sign of strength. And the test came back down and did not break the previous support. So that was all on. But as you can see, a lot of whippy lashy stuff in here. So it's also inside the pattern, so it's quite tricky. So really, until you started seeing this high volume and breaking the supply lines, this was the zone here for retail traders to get in. And we get the same sort of thing going on up here. Here's another. Sorry. Here's the button. Other entry zones based on E6s. Now let's have another look at another pattern which is I would call incubating. It's building up. The GLD or gold chart. Well, it gets a bit emotional about the gold, but here we have our resistance. Wait a minute. Okay. Here's our resistance. The price came up to resistance. This is your strength. Let's see the change in volume. We're going to smash back down into our range. Alright. Smash back down into our range. Because it moved up too quick. Obviously, they're going to play this out a little bit longer. We want to watch and see what happens now, but there's something else going on in here. There's a change of behaviour. Supply lines. There's a supply line busted. What's this one doing? See, just came up to the supply line. The supply line was busted. It came up to the supply line. This is a channel line. So the shorts have another go. So now we see how this trend builds up. My suspect is that we might see 3 to 6 months of it going sideways and then finally having a go at the supply line. This is the fade. This will be the breakout. Obviously, if it continues on down, then the story changes. So I would expect an E6 trend, E6 buying to be higher up, closer to the 130, and E1 and 2. And E1 is closer to a 100. We'll have to see what an E2 maybe just a breakout, but I'll be waiting for it to get a little bit higher. Thanks very much for watching.